Hi everyone, it's Randy Pertler. Welcome back. I'm glad you joined me here. And if you haven't already, please subscribe to my YouTube channel. Just click on subscribe, and that way you'll be notified whenever I release a new video. Hopefully you're enjoying the videos and you're also finding them to be very informative and helping you in your real estate investing endeavors. Today's real exciting day, a topic that's very near and dear to me, and actually a strategy that can significantly change your life as a real estate investor. Most people think, hey, I've got to have good credit and I have to have a lot of money to be a real estate investor. Well, by applying the strategy that I'm about to cover, subject to acquisitions, all that can change for you. Absolutely change 100%. This is a way that you can acquire properties with no money and no credit. Or let's say it this way, very, very little money and no credit. Could be as low as $52. And I'll explain how that works. So let's first understand what a subject to acquisition is. Okay, subject to is short for subject to existing financing. So in other words, if homeowner A has a house and they want to sell it to purchaser B here, though the deed needs to be transferred, right? But there already has a mortgage on there, and a subject to means that homeowner A is going to keep the the mortgage in their name. They're going to deed the property over, but they're going to keep the mortgage in their name. Now, why in the world would anybody do that? That's probably what you're thinking. What? Someone's going to deed over their house and still be liable for the mortgage? Believe it or not, the answer is yes. Now, as a real estate investor, I look for problems and then I try to solve those problems with the right strategy. This is the right strategy for many people, many homeowners. This is maybe their only strategy that they have left. So let me just tell you a story. Let me tell you a story about the first subject to deal I ever done. So I'm calling Craigslist a list of people that have properties for rent. And so I'm calling the Craigslist and I see this person has a property for rent for $1,400. Now the reason I was actually contacting them was not because of the subject to. I was actually building my buyer's list. I wanted to build a buyer's list of investors, people that paid cash for properties or at least had the resources to buy properties, and I could get them under contract and wholesale them to investors. So if someone's renting out a house, it's usually one of two things. Either they're an investor and they have that house and maybe other houses, or there's someone that couldn't sell that house and now they're forced into renting it. Maybe they inherited that house. It's not really selling right now, so they go ahead and they're going to rent it out. So I called this ad, and I called the gentleman. I remember distinctively the conversation. So I started out my little, my little one or two sentences. I said, "Hi, my name is Randy Pertler. I'm a real estate investor. The reason I'm calling you is because I see on Craigslist you're advertising a house for rent. I thought maybe you'd be a real estate investor like me and want to buy more properties. If I was to find properties that are 60 to 50 cents on the dollar, would you be at all interested in buying some more properties?" Here's what the guy said. "Heck no." He didn't just say no. He said, "Heck no, I don't want this one." I'm like, "What are you talking about? Why don't you want this one?" And he said, "Well," I said, "No." I said, "Why don't you want this one? What's wrong with it?" He said, "Well, there's nothing wrong with it." I said, "Well, why don't you want it?" And he said, "Well, it was a rental property that I bought when I lived in the area, but I've moved out of state and I had it sold. I thought I had it sold on a lease with an option to buy. Well, the person that was leasing the property lost their job. They had to walk away from the deal, and now I got to fix it up. I just fixed it up and I'm renting it again, and I'm out of the state." So logical question was, well, why don't you sell it? Keep in mind, we're problem solvers, and that's how I see myself. And if I was just calling to build a buyer's list and I was focused on what I was trying to do, I would have missed this opportunity because he would have said, "Heck no, I don't want this one." I'll be like, "Well, good luck, bye," right? But he's got a problem. Anybody that says, "Heck no, I don't want this," he's got a problem. I'm trying to find out what his problem is. So again, that second question was, why don't you sell it? And he said, "Well, that's the problem. I've got very little equity in it. I owe about $120,000. That's probably about all it's worth. Might even be worth a little less than that. By the time I pay real estate commission, I pay attorneys, closing costs, transfer stamps, all this kind of stuff, I just can't put that much money into it, so I'm renting it out." And I said, well, have you ever thought of a subject to acquisition? And he said, well, I don't know what that is. And I said, well, let me explain it to you. So subject to acquisition, let's just say in this example, if we were to do it, is that you would sell me the property. You would deed the property over. In exchange for that, I would sign a legal document stating that I would make your mortgage, on-time mortgage payments until I either sell your house and pay it off, pay your mortgage off. 2, I refinance it and pay your mortgage off. Or 3, I just accumulate cash and pay your mortgage off. So it either it's going to get, you're going to stay on the mortgage until I either resell it, I refinance it, or I just pay cash and pay it off. So, I mean, these are going to be legal documents that I'm going to sign and notarize. And so he started thinking about it a little bit, and he said, well, if I don't have to come up with any money, I might be interested in doing it. I said, listen, I'm not sure if I'm interested in it. Let me ask you a couple more questions. 1, I see that you have it advertised for $1,400. How much did you have it rented for before? He said $1,400. I said, okay. What's your total payment? Principal, interest, taxes, insurance, everything. What's your total payment? He said, well, it's about, I think it was about $1,150 at that time. It's changed a little bit with the taxes going up and down, but I think it was about $1,150. So obviously I did some math in my head. It's $1,150, $1,400. So I believe that's $250 positive cash flow every single month for little or no money. Now obviously there could be repairs and things. So I said, listen, I might be interested. Let me go in and take a look. You have somebody local here that can let me in, so I can go take a look at it. I want to see the property. I want to analyze it a little bit, and I'll get back to you and let you know. So he said, okay. So called him up again after I looked at the property. It was beautiful, by the way. They redid it, and it was in great shape. Perfect to rent out right now. So I agreed to do it. And the only thing, he says, the only thing is I don't want to put any money. It's not going to cost me anything, right? I said, no, it won't cost you anything. I'll cover the closing costs, whatever the closing costs are going to be. So I end up getting this property. And since I did this one through an attorney, now the other ones I've not done with an attorney, but this one, first one going through, we closed at an attorney's office, paid maybe $350 or something like that, maybe another $50 to record the property or the deed. So maybe about $400 all in. I've got a property that now can cash flow as much as $350 or $250 a month. Plus, the mortgage is being paid down. Think what's happened to that mortgage. It's called equity buildup. So even if the value of the house doesn't change, as that mortgage balance starts to go down, the difference between the mortgage balance and the value of the home is called equity. I'm building equity every single month because that mortgage or that renter is making their rent payments, and I'm using those for the mortgage payments, and the amount of equity is growing, growing, growing. Plus, that was my first one. Would I do it again now after doing them? Maybe, maybe not. But as the first one, it was very important because one of the first questions someone's going to ask you is, have you done this before? And if your answer is no, then they may be a little more skeptical. It might be difficult to get the deal done. But I wanted to have that first one under my belt. I knew that I might be taking on a negative cash flow. But listen, as an investor of rental property, I don't buy based on equity. You can't spend equity unless you refinance it or sell a house, right? So I looked at it strictly for cash flow. If I keep it for 10 years, I cash flow for 10 years. And by that time, I'll have equity in the house and I can sell it if I want or refinance, whatever I decide to do. The person that I did this transaction with, he loved it. He loved how everything worked out. In fact, he later called me and asked if I could help him subject to one of his other properties and out of state, so I didn't get involved in it. But also, he calls me usually kind of related information, related issues, maybe related to the house, about the mortgage or whatever. He might contact me once a year, but every time he contacts me, he thanks me for helping him out of that situation. So that's a subject to acquisition. Now that's only one story, right? But think to yourself, how many people are there out there that if you knew how to help them and who it is that needs the help, how many of these subject to deals could you do? That's the beauty of subject to. unlike getting a mortgage in your own name, no matter how good your credit is and how much money you make, there's going to be a limit to how many mortgages you can get in your name. Banks get kind of shy after about 10, take my word for it, 10, 12. Once those mortgages start accumulating, they're less and less apt to approve you. But think about this strategy. You could have unlimited amount of money, of houses, properties that you can acquire because none of the mortgages are in your own name. All right, so you're probably wondering, that's great, that's a cute little story, but how do I do it? And some of this information I'd learned through a formalized training program that I'd invite you to take, as I did. And some of it then through experience as far as the documentation. The documentation of this whole thing is critical, mission critical to get this right, or the whole thing could blow up in your face. So the documents that you need is a couple things. One is the buy-sell agreement, which you think, oh, that's pretty easy, a buy-sell agreement. Of course, every deal needs that. But I have special language in this that applies to taking over their mortgage balance and stating that you're buying it for either a certain price or the mortgage balance, whichever is lower at the time of closing. So this is a very, very important document. Also, in this, at the very end of this contract, I have an addendum. And this is the due on sale acknowledgement addendum. This also is very important. Let's address this right now. Okay, because you're probably wondering, wait a minute, that was a nice story, but if I'm deeding my property over, isn't my mortgage due? Isn't my mortgage have to be paid off when it transfers ownership? Well, yes and no. Here's what the due on sales clause. It's an acceleration clause. Look at your mortgage, and whenever I help somebody with this strategy, we get out their mortgage and read their mortgage. Let's not make any assumptions. But almost every due on sales clause, acceleration clause that I've ever seen in a mortgage states something like this. If the ownership of the property changes, sometimes they'll say as much as 25% and higher. But if the ownership of the property changes, the lender, at the lender's discretion, may call the mortgage due. What's the key word? May. Doesn't mean that they will, that they have to, that they must. It's may. Now let's look at this logically. If a company, if a mortgage company, if a lender has on-time monthly payments coming in month after month after month in exactly the terms that was agreed to initially, are they going to call the mortgage due? They would be losing their business. Mortgage company slash lenders, they're in business to lend money. That's how they make their money, right? Paying that interest, somebody paying that interest. If they foreclose, they just have to find somebody else, find another customer to lend it to. Why would they do that when they already have a good paying customer at that house? Plus, to foreclose, it's expensive. I've heard some numbers where it costs, the average foreclosure might cost a lender $50,000 in loss. Because once you start to file for that, they might stop paying the mortgage. And it takes sometimes a year to get them out of that property. So it's not a good deal for the lender. So the important thing is to make on-time mortgage payments once you take that over. And so that due on sale clause, I have the sellers acknowledge that in the document. So in my contract, in my agreement, I have an acknowledgement, an addendum that states that they understand this, right? I'm not going to go into the details in the interest of time, but it states exactly what the due on sales clause is, and it also spells out what the recourse is if for some chance the bank accelerates the mortgage, is what they call it. They accelerate it. They usually give them 30 days. So they'll give a letter, say, hey, we understand that the property has changed hands. We're initiating the acceleration clause, and this is due in 30 days. Now, even if that was true and it was due in 30 days, well, again, if they want the house back, it's going to take them months and months and months through the legal process. And in some states, a year for the legal process. But we don't want to go there, right? We don't want to go there. So in my, I try to protect people like I would want to be protected, right? So in my document, I tell them that if the seller does get a notice for the acceleration clause, the due on sales clause, to be activated, if they do get that notice, I have 30 days. I think I have 60 days. I'm sorry. I have 60 days to do one of a couple things. One, pay off the loan balance. So if I have money, I can pay it off. Two, refinance it and pay it off. Three, sell the property and pay it off. Or four, the very worst case scenario for me, it actually could be a good deal for them, but the worst case scenario for me is if I can't do any of those options, I will deed the property back over to them. Now think about that. You say, well, they didn't want it in the first place, but let's say I made mortgage payments for them for 3 years and property values went up. Well, before they didn't have enough equity to sell their house. Now they're going to be in much better shape to sell their house. They could probably sell it conventionally now because now they would have the equity in the house and they could pay for the real estate broker, they could pay for the title company, they could pay the closing costs, et cetera, right? So this, you see how this can be a win-win situation for the right person. I even have them, and normally you don't see this on contracts, I actually have them notarize, sign and notarize both myself and the seller on this form. So this is critical. This has taken me years to develop this in multiple subject to acquisitions. So that's one piece of the document. Another thing that I have here is the letter that you want to send to the mortgage company. And this is critical. You got to give them enough information, but not too much information. So this is the letter that the seller, the person selling that's still on the mortgage, this is what they send their mortgage company. Now, oftentimes when this happens, one of the first questions I'll ask to the seller is, what is your plan? If this is the primary residence, what is your plan? Are you going to go out and you want to buy another house? And the reason that's important is because by staying on this mortgage does not mean that they can't get another mortgage, but it means that it changes their debt to income ratios and it may make it a little more challenging for them to get another mortgage. So I usually ask that question, what's your plan? A couple of the people are like, oh, I already own another house because this was a rental property. The person I talked to that was their primary residence, they said, well, no, I'm going to rent for years. I'll just rent for a while and see. So great. I explained to them about their debt to income ratios and how that can affect. If they go out, because I had one person say, oh, we'll be a renter for years. Well, within a year, they contacted me and say, hey, Randy, I know we told you we're going to rent for a while, but we actually want to buy a house, and they see we're on this mortgage. Can you contact our new lender to explain to them what we've done with this subject to acquisition? So I had a conversation with the lender. I actually provided them with this documentation, and they were able to get approved for a mortgage. And basically what this documentation is stating is that I'm legally obligated to make this mortgage payment on that house until I either pay it off, refinance it, or sell it. So they were able to get approved based on that because it was a wash. This gives you, this has a debt of $1,200, but you also have income at $1,200. So it was a wash. Now their debt to income ratio, they like to see it better than 50-50. So they still had to have good income coming in order to get qualified. A couple other things I want to share with you is this document. This is in the state of Illinois. It's my declaration. But the reason I want to bring this out is people say, oh, you got to have a title company, you got to do this, you got to have an attorneys involved. You know what? My first one I did, I had an attorney involved, and I coached the attorney through most of the transaction. So you don't need to have an attorney involved. I'm telling you this, okay? That's very important. But you do need to get it. You need to get these documents all recorded. And you say, well, what about transfer stamps? Well, here was great. This is, I'm going to read this. This is from Illinois. You check your own state. But when I'm filling out the information for the transfer stamps and how much it's going to cost me to transfer the ownership of this property, line 15 says, outstanding mortgage amount to which the transferred real estate remains subject. Let me read that over again and do a little better job. Outstanding mortgage amount to which the transferred real estate property remains subject. That's a subject to. People are subject to, you can't do that. It's in the state document asking you, well, how much of the mortgage is still going to stay intact? In my case, all of it. And so the transfer stamps on this one, even though it's not a, quote, exempt transaction, it's still 0 transfer stamps because there's no exchange of money. No money needed to be paid. And then, of course, you got to record it with a deed. So I have an example of the deed that I used to record it. In counties, it's going to vary county to county and how long your deed is. Most deeds are like 2 pages. So deeds usually cost me about $52 to record. So think about it. I could buy a property for $52 down if I knew what to do and I had the proper paperwork. Here's what I'm going to offer you today. You're not going to believe this. Never done this before. This has been my blood, sweat, and tears coming up with these documents, modifying other documents that I've had over the years. These are the best. Now, if you subscribe to my YouTube channel, you got to be a subscriber. So if you haven't subscribed yet, click subscribe. All right? Then read down in the description, and I will give you a description of how you can get these documents for $20. That's right, $20. It would take you longer than, I would say, 2 hours to type them up yourself. And if you're only paying yourself $10 an hour, this is already a better deal than you coming up with these documents on your own, right? Now, here's the disclaimer. I'm not an attorney. Let me say that again. I'm not an attorney. I don't even play one on TV, all right? I am not an attorney, so you should always, always seek legal advice. But this will save you so much more. By reading these documents, you will understand what the process is, the documentation you need, and then you can take these documents to your attorney and say, hey, I want to do this subject to acquisition. Here's these documents I had. Can you review these and approve them? And maybe he wants to make a little bit of tweaks. But if you have questions about it, you can reach out to me as well if you get these. So I'm going to say that again, $20. How to do that will be in the description below, but you do have to be a subscriber to my YouTube channel. So please subscribe and get these documents that will save you so much. And think of the potential. Think how many people you could help. And people are worried, oh, what about real estate going down again? Oh, I'm afraid about the real estate market. It's been going like this at a steady climb for a while. What if it starts to go down? Perfect for this. Think how many more people are going to need your help doing this subject too. Think how many people are not going to have any equity in their house and still have to move. Maybe lost their job. They're not going to be able to afford the monthly payments. You can step in and help them and then rent the property out and build a massive real estate rental portfolio. So sorry I went so long. There's just so much good content in here. I wanted to make sure I covered it all with you. So again, subscribe to my YouTube channel. If you want to reach out to me, you always can email me at randypertler@onlineowners.com. That's online owners, plural, online owners with an S. Thanks so much, and may God bless you and your family. Bye-bye.